Bringing now Evercore ISI, their senior managing director, Julian Emanuel. And I love the title. But let's unpack it because I don't know exactly what it means. Bear trap, is that a good thing or a bad thing?
That's actually potentially a good thing. Remember, it's almost like deja vu. We were probably having this exact same conversation a year ago today in the midst of the tariff tantrum.
I hope we don't make this an annual spring ritual.
Well, no, actually, if you look at it, Charles, stocks tend to have major turning points in March and April. So it's not entirely inconceivable that we get the same setup in the next several weeks. It's just a function of the fact that when you think about the structural bull market that started in 2022, we don't have a recession in front of us.
Right.
We have obviously elevated geopolitical risk.
Right.
And we have yields. We don't think yields are going to be the headwind that the market is pricing in now.
Why is that? Why would it be different? I mean, again, I remember not long ago, 5.5% on the 10-year was the, be afraid. Then we pulled back. Then 4.5 was the area, be afraid. More recently, it was 4.1. We're above that right now. Why isn't that going to be an issue?
So two things going on here. Basically, first, U.S. yields have been dragged up by the rest of the world, which is much more sensitive to the oil price shock because they're all getting their oil from the Strait. But if you look at ours, we're still within that range, right. Call it 4 to 4.6. And again, at the short end, if you look at the price action in gold, copper, and aluminum over the last week and a half, it is not clear at all that this is a blatantly inflationary shock. Sometimes oil causes deflationary aspects.
When is that? Is that because of just supply and demand by dynamics? Why would that be a deflationary aspect?
It's because of growth fears.
Right, okay. Good. Geopolitical risk. Obviously, we're sloping much higher. We've been here before. Is there anything different right now than the ones that you've lived through before, that the market's been through before? Or how do we use this as sort of a template to kind of give us a guidance here?
So this one, granted, is definitely a little different. It feels like the oil price shock is very, very much less directly in our hands and much more dependent on how the course of negotiations go for the next week and a half. And the fact is that the oil price has moved to this level in the 90s on WTI, and more importantly, $4 a gallon at the pump, to where if it stays here for, call it another month or so, you will have adverse effects to both the economy and further adverse effects to the markets. But that's not our base case.
All right, your bull market base case based on earnings, strong economy, large-scale hedges. But what you just told me was kind of fascinating because very few people are willing to give me a time. You're saying this lasts a month out. If we get to these a little bit higher elevated levels on oil and gasoline, this changes everything.
So we've already had a month of this stress, essentially, and our work shows that typically 2 to 3 months out is when you get to the point where the economy starts to bend, and the market tends to anticipate that. And that, for us, is really, sort of the stress point. Where you don't want to get to is Memorial Day, when the driving season and the grilling season starts, and affordability is still top of everyone's mind.
So earnings we feel good about, right? And what's interesting, earnings, we had an amazing earnings season that did not move the needle. Right now we're talking about stocks that went straight down on earnings. I don't know if it's price for perfection or whatever, but you feel confident about earnings right now. So let's just go down to large-scale hedges. How does that play a role for our viewers?
So we've been, the gray hair that you and I have, I've been doing this since being a young trader during the original Gulf Wars, okay? I have never seen...
I thought you were going to say when Alexander invaded, but I'm with you.
Not quite that long. I've never seen cumulatively the amount of hedging bearish in stocks, bearish in credit, actually this week bearish on interest rates, and bearish on gold in my entire career. And that is typically a sign of something that at some point those hedges are going to come off when we get some sort of stabilizing news.
Oh, okay. So it's a contrarian thing. It's sort of like when something's too short or whatever, just too much bearishness, essentially. too much pessimism.
It's where we were at the tariff tantrum low last year. Our clients, 81% of them, thought we were going to be in a recession imminently in 2025. That was the reversal signal.
Outperform communication services, consumer discretionary, information technology. I would suspect the middle is the wild card again if we get to with the oil prices.
It is, but the commonality of all these threes is the AI exposure, sort of the Mag 7 exposure. And it's incredible to think it, but those are now amongst the relatively cheapest stocks in the market, with still very strong earnings profiles.
Let's talk about cheap stocks in the market. The dogs of war stocks trade below pandemic valuations. Credit markets remain calm. So you've got two charts here. I thought they were absolutely fantastic. Your next, the 200 next 12 months PE trades. Again, we've come down a lot in terms of valuations. So these stocks, I guess, for lack of a better term, just look cheap. They look very, very cheap based on historical norms.
They do. And look, valuation alone isn't a reason to buy or sell a stock, but valuation with a still accelerating earnings profile, even in this time of stress, is a good reason.
So obviously we're waiting for the next communique, see how the negotiations go. I thought there was a great chart I used yesterday from BCA that suggests the longer this goes, at some point it will create global recession, and at that point there'll be Katie bar the door. All of the neighbors of Iran will get into the fray. Everyone will get into the fray. And at some point, Iran won't have any capabilities at all. But the damage between then and now could be substantial and linger for a long time.
Well, that's why to us, the next month is so important. We have to have a diplomatic breakthrough because the importance of getting the oil price down, that acronym, FNAO, failure is not an option.
Well, I know snafu. Let me ask you, before I let you go, if we do get it done, 1-2 weeks, all of the great momentum that we talked about in your bull case, that should still be in place, right?
Yeah, the structural bull market, in our opinion, remains intact.
Julian, thanks a lot. Needed you today. Appreciate it.
Sure.